Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
By the way, we'll have some extra time tomorrow as well, on Thursday. So usually it's 2 to 3, right? Just booked another hour on Thursday. I could actually let go of this class, but time window is too short actually to really do anything. But that's fine. Let's start. Yeah, I think this is a good class size for advanced class. All right, so today I want to talk about mainly investment horizon problems. Maybe tomorrow I'll talk also on conditional models. All right, so before I actually talk about this, right, so by now you should sort of be able to do a lot of investment problems, right? So for example, a lot of you, when you graduate, you may be what's called financial advisors, right? So what does a financial advisor do? They recommend investment, right? In particular, like mutual funds, ETFs. By mutual fund ETF, this is already a diversified portfolio, right? And they'll ask you, like how old are you? What's your goal? Are you saving for retirement? A bunch of bullshit questions, right? But there's something in their questions, right? They're trying to sort of evaluate your risk aversion, for example. They're trying to evaluate your investment horizon. That's what we will talk about today, right? If anyone is interested, one of sort of the hottest field in finance is fintech, right? One of the hottest trend in fintech is the robotic advisors. Right, so you write a robot, right? And you can just have a web page and people will log on, say, how old I am, what's my saving goal, and other sort of related, unrelated questions. Then at the end, they will recommend some investment portfolio for you. Usually it's like ETFs, a combination of ETFs, things like that, right? The advantage of that is it's really cheap because it's scaled, right? Everything is done at the back end by the program. Usually, the investment advisors are paid by a proportion of an investment, right? But that's like very expensive, right? That's because you want to sort of give the agents or investment advisors incentives to actually work hard to, recruit your investment. But as you notice, a lot of time, it requires more of sort of human skills, right? Your interpersonal skills more than the investment skills, right? But recently, like in the US, there's a lot of litigations saying, your investment advisor should act in the best interest of the client, right? So because of new laws, sometimes investment advisors are sort of subject to what's called due diligence risk, right? So they'll say, oh, you are recommending it because you can earn a higher fee, not because you actually believe this is a better investment. So one of the trend is to use a robot to actually, sort of have a scientific way or semi-scientific way to recommend that. So the ingredients these robots use are actually just the ones you actually learned so far, right? So your allocation should depend on your risk aversion, depend on your investment horizon, I'll talk about today. Depends on estimate of the different classes of assets, their means, the standard deviations, things like that. All right, so in last week, what we talked about is mainly the predictability cross variables, not just by itself, right? Mainly in cross variables, using DP or similar variable to predict the expected returns. Right, so the sort of the VAR model we end up with is that DP predicts expected returns, DP predicts the future DP, but DP do not predict the change in the dividend. Right, so this obviously has implications in asset allocations. Right, so to sort of frame our thinking, let's keep the assumption that the realized return itself is a random walk. Right, so investors are still rational by and large, so which means the realized return is just the expected return plus some error. Right. But now, because of what we learned from last week, now let's make the expected return itself, that's called XT, to be predictable. Right? You can either predict from DP t minus 1 or predict it from expected t minus 1 RT. Right? They're actually sort of similar because it's cross prediction variables. Right? So now what's the implication? So if you want to sort of make things sort of rigorous, right? Because I want to do the sums, so I want the logarithms. So if I write everything in terms of logarithms, then the excess return, I need to minus the RF, right? And because this is a logarithm, remember the log-normal property, right? I need the half of the variance there. Right? But that sort of details later on we'll sort of throw away. But to sort of make it rigorous, this is how the expected excess return in log form that's defined. Right, so now what I want to do is to write this log expected return in predictable form, right? So I write as xt plus 1 equals to this phi xt plus 1 minus phi. So you notice phi and the 1 minus phi, right? So this is sort of similar to what's called error correction models. 1 minus phi times this mean mu plus some random variable eta. Right? And this phi is between 0 and 1. So if you notice, if I take the expectations on this both sides, right? So I'll have expected x equals to phi expected x plus 1 minus phi mu plus 0. Right? So which means I can move this side to that side, so that will be 1 minus phi expected x equal to 1 minus phi mu, expectations, right? Which means expected x equals to mu. Right, so this is workable because in the very long run, expect xt plus 1 and expect xt is the same, right, asymptotically. Right, so asymptotically, the unconditional expectation is just mu. Doesn't change. Right? Although we write it as a predictor form, but it's still our mean mu. If we set phi equal to 0, right, then xt plus 1 is just equal to mu plus eta t plus 1. That's just a random walk model. Right, so this is the form that can sort of incorporate both sort of the predictable mean reversion, expected return, and the constant mean in the long run. Right, so now let's get some data first. So this is the factor returns, right? I calculate what the market return is, and I calculate the excess return in log form. So the log form is calculated by log of 1 plus r, basically. Right, so that's the function to calculate the log. Right, so now R is the excess return, RF is the risk-free rate. All these are in log forms. All right, so just to check, the mean log return is about 0.48%, but this is by month, right? So if you times 12, it's about 5 point something, approximately 6%. And there's a standard deviation is like 4%, variance about 0.19%. All right, so that's the data we have. If you just look at the excess return itself in this data, monthly return, well, this looks like has autocorrelations. Right? Looks like it's kind of predictable, but this shouldn't be very surprising to you by now because, you know, even if it's sort of predictable, doesn't really mean it's causally predictable, right? It's just sort of can be the fluctuation of expected returns. Now, how do we put this data into this framework? So as we said, we have two equations, right? One equation, the first top one is for the realized return. That's a random walk. The second equation is for expected return. That's mean reversion, right? And the difference between xt plus 1 and expected RT plus 1 is just risk-free rate and half variance. Okay, so they're actually correlated. So each of this epsilon and eta, they are independent, but cross equation, they can be correlated. Right. So now I want to sort of plug in the second equation into the first equation, right? So looking at the perspective of the realized returns. So what's the realized return? You just take the top equation, right? And you realize this expected RT plus 1 is connected to the xt. Right, so this expected RT plus 1, if you just go back, expect RT plus 1, that's equal to xt plus RF minus half the variance. Right? So you just plug this into the realized return equation. That's what you get. And now we can use this equation for xt. Xt, well, in the top equation we have xt plus 1, but so we can just lag one time. Xt will be phi of xt minus 1 plus 1 minus phi mu plus eta of t, and you just copy the rest there. Right? Once you did this, then all we need to do is just sort of collect the terms, do some simple algebra. We ended up with this bottom equation. If you look at the bottom equation, this is RT plus 1 equal to phi of RT, right? Plus this second term that's a constant, right? And all the rest here is just the error terms, random variable. Right? So we know that with the correlation or expected return, then the realized return could also be correlated. Okay? But if you want to sort of test this, it's really very difficult to actually test because of this error structure and because of estimation in the AR process. Right? So we could end up with some mean reversion in expected returns, but if you look at the realized return, you don't really see a lot of mean reversions. Right? But they are, in fact, underlying model, they are actually correlated. They are actually having the mean reversion. So you don't really need to know this if you don't want to. But this is just to generate this correlated errors. Right, so this error is generated by this random multivariate normal, and this random multivariate normal has this covariance, and this how much is the size. And if you look at the covariance, you have sigma square on the diagonal, and off the diagonal you have sigma 1, sigma 2 times the rho. So that's basically correlation coefficient, the covariances. Right, so this shows you can have correlated variables in two variables, and they are sort of normal in correlated way. All right. Now we can just sort of follow our model to write what's my expected return xi. Xi equal to my phi or phi times xi minus 1, so t minus 1, plus 1 minus phi times mu, plus this first random variable eta I, and then the realized return RIT equals to x of I plus RF minus half variance plus the random walk in the realized returns. Right? So these two actually can be correlated. So what I generate is two series. I call it return 1 and the return 2. Return 1 is expected return series. Return 2 is the realized return series. Right? So, you know, this, because this is really squeezed, you don't see a lot of difference between this series and the random walk, but this is more sort of correlated than the random walk. Random walk is more sort of random than this. All right, so if you sort of pull this graph horizontally, you will see something like stock movement going up, going down, instead of just going up, down like this. Okay? So what's our generated expected returns? That's our return 1. Right? So if you just sort of do the AR regression, well, this is quite close. Remember the coefficient I set here, phi, is 0.1. All right? So the estimate is 0.1. But if you look at the realized returns, although coefficient should be also, underlying coefficient should be also phi, the autocorrelation, but you can't just estimate it. When you estimate, this is way smaller than 0.1. Right, so you have this phenomenon of the realized return are not that correlated, but underlying they actually correlated in the expected returns. So even you observe something that looks like not very correlated, but the underlying process can still be quite correlated. So what's the implication for our investment horizon? Well, first thing we want to do is to calculate the covariance of the return process. And you notice this covariance is conditional covariance. Okay, so everything has this subscript T here. Right, so this conditional covariance meaning I already know the information at the time T. Right, so if there's any predictability, I can use this information. Okay? Now, what's the covariance of RT plus 1 and RT plus 2? So the two-period covariance, that will equal to covariance of RT plus 1 times the expected return in the second period plus the error term. Right? And we know this expected return equals to xt plus 1 plus RF minus half variance. All right, so now this covariance just is between return of t plus 1, the realized return t plus 1, and xt plus 1. And this is a constant, doesn't really matter. And this is a constant, doesn't really matter. And you have error term t plus 2 here. right? Now we said this error term t plus 2, because the error itself is not serially correlated. So epsilon t plus 2 is not correlated with RT plus 1. Okay? So the only covariance that could be correlated is just between RT plus 1 and XT plus 1. Right? So what's covariance between RT plus 1 and XT plus 1? You realize that XT plus 1, I can write it as in this mean reversion form. Right? So that means I can write also as the realized RT plus 1 equals to expected RT plus 1 plus some epsilon. Right? So if I just put these two together, you notice that this is expected T RT plus 1. Is this random variable or number? Suddenly I ask you a question, right? Is this a random variable or a number?
Hold on.
Well, if you look at the answer here, you know this is a number because there's no correlation between this one and eta and this one with other things. But why is this a random variable? Why is this a number, not a random variable?
Because it's expected return and no x.
So when I talk about this equation at the beginning, what did I say? All the covariances are conditional covariance, meaning I know the information at time t. If I know the information at the time t, I already know the expected return of t plus 1 at the time t. Okay? So if I have an expectation about next month's return, that expectation is a number. It's not a random variable anymore, right? So all the other things just go away because there were the numbers at the time t. So the uncertainty is about between epsilon t plus 1 and eta t plus 1. And that's the covariance of eta epsilon that we sort of end up with. Right, so as I said here, the expected T RT plus 1 is not a source of risk for investors. What does that mean? That means it's not a random variable. It's not a source of risk because it's no number. Right, so now we need to figure out, is this covariance between epsilon and eta, is this positive or negative or zero? Right, so from what we learned before, from this mean reversion in the conditional information, we know this covariance should be negative. Why this should be negative? Or how do we actually explain this is negative? This negative meaning when you have a very high epsilon, you must have a low eta. Right? So what does a high epsilon mean? High epsilon means when you have a very high unexpected return. Right? A very high realized return. A very high realized return, that means the expected return in the future must be low. So eta must be low. Right? So this is just like what we call in DP regressions. Right? So when you have a very high realized return, that means your P in current period is really high. That means your DP is really low. And because DP positively predicts the return, right? So if DP is low, the future return, expected return will also be low. Right? So this correlation or covariance between this epsilon and eta is actually negative. Right, so once again, I want to caution you, all the calculation here is the conditional covariance, right? Knowing the information at the time t. If you want to look at the unconditional covariance, that still can be positive. Because unconditional expectation not only depend on this covariance, it also depends on the variation in the expected returns also. Okay, so what does that mean? Right, this is just from the last week. You have the VARs of two variables, right? And I think on Thursday or something, on the workshop, I show you this, right? The multi-period return is some, the B times 1 minus phi BPT plus some error term. If you go multiple more periods, this becomes B 1 minus phi plus phi squared DPT. Right, so I told you this means over the longer horizons, returns are more predictable by the DP. Right? Now, if this error term in DP and error term in the return, they are negatively correlated, that will make the optimal allocation to actually increase with the horizon. Like that's what I observed last week. So now we want to see why. What is this thing? Okay, so this is, so before that, the simulation we have is rho equals 0, the correlation between epsilon and eta equal to 0. Here I have rho is negative, okay? And you will see this further shifts the autocorrelation in realized return away from the 0.1 we have. So you can it's even harder to detect the underlying autocorrelation process of expected returns. Okay, so what we have seen is the correlation between RT plus 1 and RT plus 2 is negative, okay? Then I want to put it in use for the investment. Right, so if you read the book by Stephen Siegel, he has this book, quite famous, titled The Stocks for the Long Run. Right, he says stocks are actually either safer in the long run, right? And the long-term investors, they can afford to wait out the ups and the downs of the market. So if you think, well, what does the wait out up and down the market mean? That means the expected return is mean reversion. Okay? So what he basically says is that when the expected return is mean reversion, then the multi-period variance of the stocks will be smaller than the one-period variance. Okay, so if you have a longer horizon, the variance decreases. It's safer. So, yeah, so that's what it means. So the variance of return t to t plus k divided by k, so there will be per period, will be decreasing or smaller than the variance of t to t plus 1 itself. Right? So by now you should realize why I use those logarithms, because with logarithms, the multi-period return is just the sum of each period returns, right? So the variance of this multi-period return is just the variance of the sum of the returns. And if the returns are all IID, the identically independently distributed, then we know the variance of x plus y is just the variance of x plus variance y plus the covariance, right? But if they are IID, the covariance equal to 0, right? So this will be equals to k. K is how many periods you have, right? Times the variance of one period return. So in other words, if returns are IID, then the variance grows at the same rate as the mean. Okay? Because when you have multiple period, your actually mean increase, right? And you have multiple period, the variance returns are independent. Your variance also increase with the rate k. Now the variance of mean reversion process, let's just take a 2-period example, right? As we said, we have the variance of one period, variance the second period, plus the covariance. Now this covariance is not 0. As we just see before, is this covariance positive or negative? Negative. So if this is negative, this will be less than this 2, or k, times the variance of RT plus 1. Right? So remember we said we sometimes test the market efficiency to sort of test whether the returns are predictable, have autocorrelations, all that. But there's a lot of statistical challenge in sort of testing the time series models. So one alternative way people come up with, this is in the famous book of McLean and Lowe, 1997, is to do the variance ratio test. If the market is efficient, then this indicates VK, which is the variance, conditional variance of return from T to T plus K, divided by K times the conditional variance of one period return, that should equal to 1. Because they should grow at the rate of K. Right? Now, instead, if the return has mean reversion, this ratio of the conditional variance should be less than 1. Which means the long-run variance, conditionally, will be actually smaller. Which ties to what this popular book says, stocks for the long run. Stocks actually are safer in the long run. Okay? Right, so as I said, what we discussed mainly here is the conditional variance. If you look at the unconditional variance, then not only you have this return process, because you have this RT plus 1 equal to XT plus the error term. So now you have two covariances, right? One is XT with XT plus 1. That's just phi of variance of X. And another one is epsilon T plus 1, XT plus 1. That's what we calculate before, the conditional covariance. So even if this is negative, the second term is negative, depending on how big the first term is, the unconditional covariance can still be positive. Right, so returns unconditionally can be positive correlated, but underlying expected return is actually mean reversing. That's kind of hard to understand, right? It looks like positive correlated, but underlying it's actually mean reversing. All right, so that's why in the real world, the return correlation can be quite hard actually to detect ex post, because we don't have the conditional information. All we observe is the ex post data. So here I calculate for k periods, for k period term, I calculate the size divided by k, takes the integer number. That's how many of the multi-period I have in the return process, right? So for example, I have 24 periods, I have three period horizons. So this will be, I have 8 such three period horizons, right? The reason I did this is I just don't want to sort of smaller number than k at the end of my period. Right? So what I did is you have sample, take the sample that's less than this n times k, so this is the whole period, and then I calculate the rolling window with k, the excess returns sum and the variance. So it's the rolling sum, so that's R1, RT1 plus RT2 plus RT3, right? That's for 3 period. And then that's the multiple period return, and then I'd calculate the multiple period variance. And then I just annualize it and calculate the standard deviation. Okay? So this will be the multiple periods variance. And what we are expecting to see is that the long run variance will be smaller, right? So if you look at this simulation, as the holding period that's in months goes up, this long run variance, or actually standard deviation, the volatility, actually decrease. And it's important that I did the annualization, right? So everything is comparable in terms of annual volatilities. So we know that's actually true in the data, right? Which means very likely the data have this mean reversion expected returns. And this is similar graph from this book by Siegel, right? So he calculates the K all the way to like 100 quarters, right? And if you look at, so this black line, or so the border line is the equity for stocks, and these dotted lines are for bonds. Right? You can see for the bonds, like this one and this one, the T-bill, and the bond held to maturity, that's actually increasing in variance as you hold longer periods. Okay, so that's why he said, you know, if you hold equities, holding long periods, the return actually decrease. But if you hold bonds and you roll over the bonds, right, and hold it for many, many periods, the variance actually increase. But still, even though we say the equity long run variance decrease, the bond long run variance increase, but still the equity is more risky than the bond, right? But you don't confuse, you know, in the long run, actually bond is actually safer. Bond is, equity is safer, but it's not, okay? All right, so I just want to show you the last point. So what does this long run decreasing variance mean in our asset allocation? Right? So remember, how do we calculate the asset allocation before?
Mean
Do you remember?
variance.
What do you mean mean variance? There's a formula, right? Mean expected return divided by gamma times the variance. Remember that? You can solve this with the exponential utility. You can solve this with the power utility. You take the first order condition, you have the solution. Remember this. Right? That'll give you the sort of proportional investment. Right? But that model is for one period model. Right? Now we want to see what happens in the multiple periods. Okay? So for example, let me see if this works. If you go to CN, right, they have this asset allocation wizard. So you get sort of choosing, what's your investment horizon, 5 to 10 years, or the 10 years, or more than 20 years, right? Then choosing how much risk can you handle, not much at all, or a reasonable amount, or as much as possible. Well, that's just a rough estimation of your risk aversion, basically, right? So I don't know what's the parameter they use. Then they ask you, how flexible are you? I can't afford any of my miss, or if I can miss some goals, right? So then they ask you, are you sort of financially literate or not? During the market sell-offs, which one should you pick? Sell stocks thinking things will only get worse? Or seeing the opportunity to buy more stocks? If you know the returns are being reversion, well, I should pick the first one, right? So, well, let me not get 20 more years. They'll tell you how much to actually invest. 25% of bonds, all the rest, like 75% in equities, right? Now,
So is this kind of like the fintech?
That's, part of the fintech thing, right? So they have underlying models. So if I actually choose instead 3 to 5 years, with other things the same, then they will recommend 70% of bonds, only 25% in equities. Right, so how do they actually do this recommendation?
How about the alternative asset?
Well, I think it's, mainly in some of these things, right? But by the way, most of these models also sort of take a difference between, small cap stocks, foreign stocks, and things like that. They're actually sort of not accurate at all. Remember we talked about investment advisors. They not only sort of suggest between the cash risk-free and risky assets, they also have these bonds and the equity allocations, right? They sort of mostly have the same sort of bias there. But what I want to emphasize is how do they actually come up with these numbers? Right, so if the returns, so this is still the log return, I just want to calculate it with, instead of excess return, I just want to calculate return itself. And I want to go through this probably tomorrow, but I just want to show you, you can have your estimation in the risky assets for one period, that's 0.62. That's the same if you calculate it by your analytical solution of mean divided by gamma times the variance. But if you do it in multiple periods, you'll see this flat line, right? So this flat line is saying your long-run holding is the same as your short-run holding. But this is the RID returns. Returns are identical in each period, not predictable. If the returns are predictable, then with the long-run holdings, you will have more weight in the stock than the short-run holdings. And then we should continue tomorrow. Great. Do I need to stop capture?